Good morning and welcome to the Daily Hunt for Multibaggers. I'm Ethan.
And I'm Brooke. We're here on Saturday, February 7th, 2026, to break down the latest market commentary from yesterday, February 6th.
We sifted through a high volume of user discussions today, flagging a number of prominent stocks. The overall market sentiment seems quite polarized, with some strong bullish growth stories popping up, but also a fair bit of focus on significant risk factors, especially around regulatory shifts and valuation concerns. Let's dive in. First up, it's everyone's favorite NVIDIA, symbol NVDA. We saw some really positive chatter, with one user celebrating NVIDIA's vindication against earlier skepticism, implying a successful bullish run. The news is just overwhelmingly good, too, with CEO Jensen Huang talking about a 7-8-year AI build-out, a major partnership with Dassault, and analysts even predicting a $5 trillion valuation by late 2026. Their revenue growth is stellar at 0.625, net profit margin an incredible 0.53, and return on equity is a stunning 1.07. Our AI models have often flagged NVIDIA as a buy in the past, including as recently as February 5th. It truly looks like a powerhouse with immense growth potential.
Well, Ethan, while those numbers are undeniably impressive, and yes, the long-term AI narrative is compelling, we also encountered a very detailed bear case for NVIDIA, initiating a short position. Their price-to-earnings ratio is 45.89, and price-to-book is 37.90, both of which are extremely high. This suggests a lot of future growth is already priced into the stock. There's also a high debt-to-equity ratio of 9.102, which, combined with some insider selling, makes me cautious. While the news about the AI build-out is exciting, the current price reflects a huge amount of that optimism. Given this, I think a cautious buy is a more appropriate assessment, especially for new entrants, down from our previous buy rating. I hear you on the valuation, Brooke, but the user sentiment celebrating NVIDIA's performance is strong. And with CEO confidence and major partnerships, those high KPIs like revenue growth and profit margin could actually be sustained. Perhaps, but that debt is a sticking point, and the priced for perfection argument is hard to ignore. Final verdict, NVDA, investigate as cautious buy. All right, let's move on to Reddit, symbol RDDT, which saw a massive spike in discussions. We saw posts like, thought this was free money, now a RDDT bag holder, with a prevailing bearish sentiment around its recent stock performance. Users were openly expressing fear, selling to break even, and calling out bears feasting on this stock. Our historical data shows a consistent downtrend, with the current price of $139.83 significantly below its 52-week high of $282.95.
Well, Brooke, while some users certainly prod in a dip, other discussions were actually quite optimistic, attributing the price drop to stupidest manipulation or institutional accumulation. They pointed to the Q4 earnings being good, TBH, with strong revenue growth of 0.679 and a massive $1 billion share repurchase program. That's management showing confidence, you know? Many users were buying the dip and expecting a bounce back, thinking it's undervalued. Our AI models rated it a stay away as recently as February 5th.
But Ethan, the PE ratio is still 53.57. That's incredibly high, even with good revenue growth. And let's not ignore the significant insider selling. Over 42% of total insider shares sold in the last 6 months. That's a huge red flag. Management buying back shares while insiders are divesting sends mixed signals. Plus, analysts are still flagging concerns about user growth. The positive news might be good, but it's not enough to justify that valuation, especially with insiders heading for the exits. Final verdict, RDDT, stay away. Next up is Global Partners LP, symbol GLP. Now, our analysis had a bit of a quirk here, discussing GLP-1 drugs, but the company name is actually Global Partners LP, which is an energy company. So we need to focus on the KPIs for Global Partners LP specifically. Exactly, Ethan. The analysis, despite its pharmaceutical leanings, still highlighted some serious concerns for Global Partners LP based on its actual financials. Their net profit margin is a very concerning 0.435%, and their debt-to-equity ratio is an astronomical 301.475%. That is a colossal amount of debt. While they do have a high dividend yield of 6.48%, it seems incredibly unsustainable given their razor-thin margins and massive leverage. There was also an error in one of the GLP entries indicating some data collection issues. Our last rating was stay away back in September. Okay, that's a fair point on the disconnect. I mean, the insider buying was positive, 2.98% net purchases, suggesting some internal confidence. And the stock is closer to its 52-week low, so maybe there's a rebound play if they manage their core business effectively. Ethan, we simply can't ignore a 300% debt-to-equity ratio and a sub-1% net profit margin for a rebound narrative. The insider buying is a small positive, but it's dwarfed by the fundamental risks. Final verdict, GLP, stay away. Moving on to HIMS and HERS Health, symbol HIMS. This one is a clear stay away. The sentiment is overwhelmingly bearish. Users are calling out their business model as not legal and drop shipping peptides. The FDA is cracking down on non-approved GLP-1 drugs. HIMS has been referred to the Department of Justice for investigation, and Novo Nordisk is planning legal action. Their stock is plummeting, currently near its 52-week low. Their PE is 44.27, which is still very high for a company facing such existential threats. And the debt-to-equity of 192.44 is just adding fuel to the fire. Our models have rated HIMS as stay away since last year, most recently on January 22nd.
Wow, that's a lot, Brooke. I did see a mention of significant insider purchases over the last 6 months, totaling 4.7 million shares. That's usually a strong vote of confidence from inside the company. Maybe they see a path through these regulatory hurdles? Not when the company's core strategy is under active DOJ investigation and legal challenge for patent infringement. That insider buying might have happened before this news hit, and the timing really matters. Their thin operating and net profit margins mean they have no buffer for legal costs or potential revenue loss. Any positive sentiment from insider buying is completely overshadowed by these severe legal and regulatory risks. Final verdict, HIMS, stay away. All right, Snap Inc., symbol SNAP. The original post was titled, "Snapped My Moonshot Ticket," with a user taking a big bullish bet. Some analysts have even upgraded Snap recently, and their Q4 earnings actually surpassed estimates, with revenue increasing year over year. You know, there's growth in subscriptions, even if ads are stalling a bit. Ethan, I'm sorry, but the user comments are brutal. They're calling the app dead, a fad, and going to zero. They're highlighting huge personal losses and ridiculing optimistic analyst ratings. And look at the KPIs. Snap is unprofitable with a net profit margin of negative 0.077 and negative EPS. Their stock is at its 52-week low. They have a massive debt to equity of 181.59. Plus, insiders have been net sellers, divesting nearly 3.9 million shares. Beating estimates doesn't mean they're making money or sustainable. Breaking the historical $7 support level is a huge technical bearish signal. Our AI model has rated Snap as a stay away consistently, most recently yesterday, February 6th.
I agree the KPIs are tough, but the Q4 beat and some analyst upgrades suggest some reevaluation, perhaps. A sharp sell-off can sometimes balance the risk.
Not with those fundamentals and insider selling. The underlying business issues are simply too significant for any speculative moonshot. Final verdict, Snap, stay away. Okay, let's look at Novo Nordisk, symbol NVO. The sentiment here is overwhelmingly bullish, primarily because of the FDA crackdown on non-FDA approved GLP-1 drugs. Users are rejoicing, expecting their investments to come back from the grave. This directly benefits NVO, a patent holder of branded GLP-1s like Wegovy, by removing cheaper competition.
Absolutely, Brooke. This FDA action is a huge catalyst. While their revenue growth was historically negative at negative 0.076, this regulatory protection will very likely reverse that trend, moving those KPIs in a positive direction. Their PE is a relatively low 13.12, especially for a pharmaceutical giant with dominant products in a high-demand market. They have strong profit margins, 0.33 net profit and 0.44 operating, and a 3.9% dividend yield is very attractive for stability. The stock is currently near its 52-week low, which given this news looks like a significant buying opportunity. Our last rating was a buy on January 10th.
I agree that the FDA news is a massive positive for NVO, clearing a lot of competitive fog. While negative revenue growth is still a concern, the regulatory clarity significantly de-risks a major aspect of their business, and the low PE could signal potential upside. Final verdict, NVO, buy. Lastly, IREN Limited, symbol IREN. They actually reported significant Q2 financial misses and a net loss, but the stock saw a strong intraday rebound. Why? Because the market is focused on their strategic pivot from Bitcoin mining to AI cloud services. There's an almost $10 billion deal with Microsoft, and users are calling this price dip a huge opportunity. It's a clear transition story with long-term growth potential. Our AI model last rated it a stay away on January 17th. Ethan, I'm highly skeptical here. While the AI pivot is an interesting narrative, their Q2 AI cloud revenue missed expectations, leading to a substantial net loss of $155.4 million, which is a stark contrast to any past profitability. Their beta is an exceptionally high 4.281, indicating extreme volatility, and their debt to equity is 33.57, which is high, especially when they're securing new loan deals for AI expansion. Plus, there was significant insider selling of 2 million shares in the last 6 months. They're currently losing money, and the AI pivot still has major execution risks, as evidenced by that Q2 miss.
The market is looking past the current quarter struggles, Brooke, seeing the long-term play with Microsoft. The rebound shows investor confidence in that future. Confidence or speculation, Ethan? Given the current losses, high debt, high volatility, and insider selling, it's far too risky for us to call it a buy right now, regardless of the future narrative. This needs solid execution first. Final verdict, IREN, stay away. Finally, a quick mention of Tesla, TSLA. Our analysis for TSLA and a bear taste discussion still concluded with a stay away rating, largely due to its extraordinarily high valuation, PE of 384, and historical negative revenue growth. Despite some insider buying, the risks outweigh the current fundamentals for new investment. Our models rated it stay away yesterday, February 5th. Final verdict, TSLA, stay away.
All right, let's round up our findings from today's hunt. Investigate as buy, Novo Nordisk AS, NVO. Investigate as cautious buy, NVIDIA Corporation, NVDA. Investigate as speculative gamble, Reddit Inc., RDDT. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making any investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
That's all for today's Daily Hunt for Multibaggers.
Thanks for tuning in, and we'll catch you next time.